And if you think I'm a dismal scientist, I want to now introduce our next speaker. Conal McQuilla can do depression like nobody can do depression. He has the great ring of authenticity insofar as for 2 decades that I've known him in Davies, he has been one of the most authoritative and credible economists in this country. And therefore, to set the macroeconomic scene of where we're at in Q1 2023, please give a warm welcome to Conal McQuilla.
Thanks, Ivan. That's quite an introduction. Hard to follow that up. As I was just coming in here, the security guard on the way in, there's some young, trendy people going to the social media event. And he sort of waved them to the right, and then he looked at me and he said, "Oh, your pensions." So, you know you're getting older. I don't know what that says about me in the audience. So look, I'd like to be cautiously optimistic today, if I might be. Hope that won't upset Ivan in terms of the outlook, or at least a little less pessimistic. And it's also been an extremely difficult year at Davy in terms of managing money. And we're actually doing a market outlook events this week. And I think cautiously optimistic is, hopefully where we'd be given the very difficult year we've had. So this chart shows the forecasts from consensus for the US, Europe, the UK, etc. And really the market, I think, was kind of baking in the worst of all worlds. A recession in the United States about to start, pretty much at the start of 2023. The UK and Europe already in recession. Inflation to remain quite high and persistent. And as well as that, central banks expected to kind of really be extremely tough. And so as I'm sure you know, over the past couple of weeks, markets have done a little bit better. And we've seen some positive signs that, first of all, if you look at Europe and the UK, they might just about steer clear of recession despite the fact of Ukraine and the real income squeeze that we've seen. So, for example, look at European industrial production, actually hasn't contracted at all, even though the PMI surveys have been extremely weak. The UK might just see around flat growth in Q4. The United States has been kind of more resilient than anyone would have expected, or certainly more resilient than some of the economists had predicted. So will we get a recession there? There's certainly a slowdown, but hard to say we'll have a recession or not. So again, just the economy's been a bit more resilient than expected. So hopefully we'll see a little bit of growth. And I think you would have seen the Financial Times last week say, for example, that the International Monetary Fund is planning to actually raise its forecast potentially at the end of January. So inflation coming down. We've seen the peak in inflation. Some more positive signs that maybe this year will be a little bit better than some of the pretty dire forecasts at the beginning of the year. If you look at that table carefully, you would have seen the UK was very much the outlier. Growth in the UK expected to be the weakest amongst the G7 and the strongest rate of inflation. I think when we look at the UK, when you stand back from the kind of drama around Boris Johnson's premiership and the mini budget, or not so mini budget in the autumn, really, it's Brexit that's hurting the UK. It's hurting export performance. Exports in the UK performed very poorly since they left the EU single market in 2021. As well as that, the UK has cut itself out of EU supply chains. The labour market is less flexible now, so they have a real pernicious inflation problem. So you're seeing wage growth considerably higher in the UK than in other countries, and obviously the Bank of England responding to that. I worked in London for 8 years. I had a great time in my 20s. I sort of had friends of mine sort of call me up and say, what on earth are we going to do when we have to refinance our mortgage? So you can see here in the chart, with the mini budget and with expectations at that time the Bank of England might have to raise rates to 6%, mortgage rates in the UK got to 6.5%. Absolutely extraordinary. Now, to come back a little bit, on average they're kind of 5.6, 5.7. You might be just about able to get some products below 5%, but this is an enormous change for a population that was used to interest rates around 1 to 2% on their mortgages. So if you're refinancing, as many will be over the next 2 million households over the next 12 months, you're going from an interest rate of 1 to 2% to over 5%. That's an enormous hit to your real incomes. And the Bank of England itself has estimated that there could be as many as 700,000 households in the UK where 70% of their after-tax income as they refinance will go on the mortgage after accounting for food and energy costs. So, a very difficult stress position for many UK households. Could hit, those are the kind of people you think would struggle to pay their mortgage potentially. A very difficult situation, and really this housing market dynamic has kind of added to the difficulties of Brexit, and we can all thank Liz Truss and Kwasi Kwarteng for that to a large extent. If you look at the UK housing market at the moment, interest rates with stretched valuations, interest rates of 5-6% just don't work. So house prices are falling in the UK now. People expecting kind of double-digit declines over the first part of, well, they've already fallen by 4% as it is, but maybe that peak to trough fall will be kind of 10-12% eventually. So, but on a slightly brighter note, just here's some of the, I suppose, good news just over the past couple of weeks and months. First of all, if we were to be really critical ourselves and Dave in terms of the outlook for equity markets and the economy more generally, what we didn't see was the Ukraine war, and in particular the big surge in natural gas prices. So, Nord Stream 1 was shut down during the summer, fully by around October, and we saw natural gas prices in Europe surge to €350 per megawatt hour and stay well above €200 for most of the year. Early this year, they've been trading around €60 per megawatt hour, so kind of back towards levels that would have been there just before the war in Ukraine. And this reflects the mild winter, but also the fact that European governments have been pretty successful in terms of building up storage, LNG imports from the likes of Qatar, the United States. So you can see the curve there. It doesn't really pick up that much next summer. I think what we'll probably see over the next couple of months is kind of a standoff between European governments and energy companies who will in some respect have locked in far higher energy costs and may be reluctant to pass these lower wholesale costs through to consumers. But as the pressure comes on, and if they do start to pass on these lower energy costs to consumers, inflation is likely to fall back perhaps more aggressively than many people are expecting. If you look at the Spanish CPI inflation rate, and that's a slightly special case because of the way the energy market is regulated, their inflation rate's already down towards 5%. So I think over the next couple of months, you'll certainly see the energy contribution to inflation fall away. If prices are actually cut in terms of what retailers are facing, and depending how quickly that happens, you will could see much more downward pressure on headline inflation rates than maybe people are expecting at the moment. I have the dubious honour of having to do my new economic forecast for Ireland in the next week or two, and the real judgment for me, and I'm going to be wrong, I'll make an assumption, but if this is passed through to consumer prices. The average household bill in Ireland has gone from around €2,000 to €4,000. If that's reversed, you could get a really much faster downward pressure on inflation. That's obviously good news for the consumer, and it's kind of the big uncertainty at the moment. Can these low prices be sustained, and how fast they get passed on? The other point is wage pressures. To a large extent, weren't really the dog that didn't bark. In some countries like Germany, yes, you do see some wage pressure, but in aggregate in Europe, wages haven't picked up anywhere near as aggressively as the United States or the United Kingdom. So there's been a little bit of good news there. Signs the US labour market is loosening a little bit. What really kind of, I suppose, freaked out central bankers last year were these surveys saying that people expected inflation to be sustained. And you're starting to see that in terms of wage negotiations and pressure on wages. That's happened a little bit in Europe. Some of the recent data is a little bit better. Again, the United States average hourly earnings is starting to decelerate. And then looking at the UK, the one country which really stands out as having extremely strong wage growth. Brexit clearly an impact there, less migration into the UK, a more rigid labour market. But hopefully, if we can see more of this, it might give central banks a little bit more room for manoeuvre on rates as the year progresses. On the central banks themselves, we are going to see more rate hikes in the next couple of weeks and months, which aren't particularly welcome. Having said that, I think markets understand that everything the central banks the literature central banks are looking at, it sort of says if you see an inflation problem, get in there early, talk tough, bring inflation expectations back down again. So the Fed is telling us they're going to raise rates to over 5%. The Bank of England is expected to peak around 4.5%. The ECB, our own Governor Gabriel Makhlouf was out telling us that we're going to have 2 50-bip hikes up to 3% in the coming months. Didn't tell us what he thought was going to happen to inflation, I noticed. But I suppose that's the issue which we discussed there. Maybe there's been some positive news. But again, if you look at these curves here, you see them shifting up over time. But markets beginning to put in rate cuts towards the end of this year. So either thinking central bankers may get to these high levels, but ultimately inflation will start to come down. The economies can't really take these kind of level of rates, And if they do get up to those levels, it'll be for only a temporary period of time, and eventually they'll have to come down again. I think if we start to see inflation come down a little bit more aggressively in the next couple of months, hopefully we will. As long as central bankers see that, maybe their tune will change a little bit on rates. Maybe we might not even get to 3.5% as some people have commented in terms of, you can see in the curve here for the ECB, maybe we'll fall short a little bit of that, despite some of the tough talk you've heard over the past week or two. In terms of equity markets, absolutely terrible year last year. And I suppose our job in Davy is going to handhold to some extent, reassure people they should be investing over the long term. So what we did in this chart is look at various past episodes where equity markets had fallen by 25%. So, a very sharp correction. And the good news, as you can see in the sort of the green parts of this table, is that in the years after this kind of correction, equity markets typically tend to do pretty well. So again, this is perhaps an opportunity. Now, it doesn't happen in every occasion, and if you're to look at the occasions where it hasn't happened, the 1970s obviously sticks out. We had kind of sustained stagflation. Interest rates kept on going up. Maybe the period around 2000 where valuations in the tech sector got extremely stretched, those are two sort of exceptions. And we'd like to believe we're not in those kind. Stagflation may go away. Concern may go away quicker than expected, and we have already seen quite a big correction in valuations, which you can see here. So you look at these valuations, particularly for Europe, there has been quite a big correction. It doesn't look that expensive. The same for the UK, although I think when you look at the UK stock market, Brexit is a concern there, and people are not maybe investing because of that. The United States, not quite as clear cut, but there does seem to be quite a big correction in European valuations, and to some extent people are speculating we may begin to see US investors move back into European markets, having ignored them for quite some time. So again, if you look at these kind of valuation charts, it says, well, maybe there's less room for concern. These are prices to forward earnings, and of course people need to see those forward earnings. We're in the middle of results season at the moment, so as long as that doesn't go too badly, I think people have a little bit more faith that we have seen quite a big correction, and there's room for to invest here. Having said that, again, you do need to be cognizant that the dollar is extremely strong at the moment. We used one of these fundamental equilibrium exchange rate estimates. You can use the 5-year average, is almost equally as good in terms of trying to predict the exchange rate. But, at current levels, the dollar does look, overvalued versus the euro. 117 would have been kind of, I suppose, the traditional estimate of, where the equilibrium lies. But again, you can invest in US equities hedged for currency movements. So, if you're concerned about that, there is ways to hedge yourself. But again, this is something we're kind of taking on board in terms of portfolio construction, that we could be hurt quite badly if the dollar were to lose value over the next 12, 24 months. On to Ireland. The first thing to say is the economy is performing well beyond what anyone would have expected. Absolutely unbelievable performance over the past couple of years. The level of employment in Ireland is already 9% above its pre-pandemic level. That's pretty unheard of. We've seen the GDP growth rates. Of course, there's a kind of a healthy debate about whether those GDP growth rates are representative, but it's not a statistical mirage. The multinational sector is clearly doing well. There's a lot of foreign direct investment into the economy. The indigenous sectors are kind of just over pre-pandemic levels, similar to the kind of rebound you're seeing in other countries. Of course, consumers are under pressure. We think we'll see pretty subdued consumer spending in the coming quarters, and then maybe a rebound in the second half of the year, and then that brings us back to inflation and all those issues. But I mean, to have the labour market performing as strongly as it is great. The public finances are in surplus. That's extremely rare. Only one or two countries in the OECD have managed that. So it's giving the government a lot of room for flexibility, and I suspect we'll see more supports for incomes if energy prices stay at a high level for some time. So look, it is a very good story, but of course brings its own problems. Just the last couple of weeks and months, I've a lot of queries on the tech sector. When people hear about job cuts on Facebook and Google and so on and so forth, it does kind of make them worried that the model is broken. I don't think that's the case. On this chart here, we're showing you where the 300,000 workers in the multinational sector reside. So let's bear in mind that over half of the jobs growth and over half of the employment in the multinational sector is not in the tech sector. It's in pharmaceuticals, medtech, business and financial services. And those sectors continued to grow very sharply last year. The IDA, which I think on balance doesn't want to overpromise and underdeliver, said it had quite a good flow of investment for the first half of 2023, had a very strong year in 2022, stronger even than 2019, and that's despite the very challenging economic conditions that we saw last year. So again, I think there's no end almost to the medtech and pharma side. It seems to be extremely strong. We certainly see a slowdown in the ICT sector, but when I've kind of looked at the job cuts that have been announced over the past couple of weeks, maybe 2,000, 3,000 jobs at most so far, depending on what Google finally decide on. There's 9,000 technology jobs added in 2022. So what you see, you look at these sort of household names, is that there's a very aggressive hiring surge in recent years. They're beginning to pare that back a little bit. But in most cases, these companies are only bringing their employment back to where it was at the end of 2021 or even early 2022. So, I think in 5 years' time, the tech sector will still be with us. It's going through a particular period of adjustment. There's winners and losers. TikTok, for example, is still expanding their employment. So I don't think it's over by any means, but maybe to some extent it won't provide quite the same growth in exports and jobs that we saw in the past couple of years. Just on the public finances, running a surplus, 5 billion, 1% of GDP, very rare, great place to be. But of course, as you know, the Department of Finance is increasingly concerned about the fact that 10 companies account for 50% of corporation tax revenues. If anything were to happen to one of those companies, we might suddenly see a hole develop. You can see, 15 billion corporation tax revenues in 2021, growing to 23 billion in 2022. I think what's really going on here beneath the surface is not just the profitability of the companies being good, but the deadline in 2020 in terms of bringing intangible property assets from places like Bermuda and the Cayman Islands into Ireland. We saw that, or had to be brought close to the substance into onshore locations. And that massive import of intellectual property products is still pushing up corporation tax revenue. So although we're kind of worried about how reliant we are on corporation tax, we'll probably be here at the end of 2023. And again, corporation tax revenues have beaten the official forecasts. So, it's not an easy place to be, but it still seems quite buoyant at the moment. Just my last slide in the housing market in Ireland. You look across the globe, people are expecting 10 to 20% declines. Canada and Sweden seem to be the two countries that have had the most aggressive bubble. And that's unwinding. People expecting 20% falls there, 10 to 15% expected in, say, the US, the UK. What about Ireland? I think we're certainly seeing a slowdown. Prices have probably been more resilient in the fourth quarter than anyone would have expected. They're still going up. In Dublin, they have fallen for 2 months in a row. And of course, valuations became more stretched in Dublin. But we had forecast 4% house price inflation through 2023. Now, then we had a big surprise from the central bank. They decided they're going to loosen the mortgage lending rules. So the 3.5 times threshold on first-time buyer loan-to-income multiples is gone. So you can go to the bank now, and the threshold is 4 times. So with the housing market as it is, and so much competition for homes, employment certainly hasn't fallen away. First-time buyers are quite likely to be going into the bank now and looking for higher levels of mortgage debt, which could drive prices higher still. The central bank itself has estimated the rule change could eventually add 8% to house prices over and above your existing forecast. They thought that might happen over 3 years. Perhaps it might happen over 1. So our forecast for 4% inflation, we'll be watching the mortgage lending data very closely to see how much debt first-time buyers are taking on. If we see that ramping up aggressively early in the year, maybe our forecast for 4% inflation this year is even too conservative. So, certainly very surprised to see the central bank decide now is the right time to allow people to borrow more. We've certainly got a lot of inflation as it is, but that's what they've done. Just on the housing market, in terms of the government's response, you see in the chart here the official housing for all targets. Extremely ambitious. Here, you can see they're building around 5,000 to 6,000 social houses each year over the past couple of years. Dara Brian's official target is for 9,000 in 2022, another 4,000 cost rental on top. I suspect the outturn will be maybe 7 to 8 at most. So, I'm sure you're aware of the political debate where the government has allocated around 2 billion per annum for social housing. Sinn Féin might say, let's double that. I think we're doing well just to spend the 2 billion that's already allocated, because of the kind of rigidities and the problems in the approved housing bodies sector and amongst local authorities, the inertia or constraints they face. I mean, they clearly have struggled year in, year out. We've actually put around €2 billion in the budget for the last 3-4 years to achieve 10,000 social houses per annum. And as you can see here, in each of those years, we've fallen short. So it's kind of a pity that we haven't had a much more mature debate about the capacity of local authorities and approved housing bodies to actually deliver this 10,000 social housing target and cost rental on top. Again, if you look at the two listed home builders, Cairn and Glenveigh would hope to build, are building 1,500 houses each, would hope to eventually get to 3,000. We're asking our local authorities and approved housing bodies to do something much more ambitious. I'm not sure they're really in a suitable state to deliver that kind of ambition. But look, I think in fairness to Darragh Breen, I think the fact he put in these very aggressive targets and the funding is to kind of provide a little bit of political pressure and ramp up the pressure on local authorities to actually go and deliver social housing. So look, I'll stop there. Thank you for listening this morning. I've probably gone slightly over time. I'm not sure if we've got time for question and answers now, but I'll be around afterwards at tea if anyone wants to approach me then. So thank you.
Thank you, Conal. Yeah, that's great. Thank you very much.